Hello, everybody. Welcome back to 21st Century Renaissance and another open interest newsletter breakdown featuring me, your host, Dr. Michael LoPiano. So great news regarding the company. Great earnings report. Very excited to see that we indeed did have a profitable quarter. That's what we thought, right? That's what a number of people over on Superstonk were thinking. Particularly liked. Surprisingly accurate what we saw, I think, from Region Formal over on Superstonk, his estimate of what the earnings report would look like. Richard's earnings report, Richard Newton, his channel here on YouTube, what he thought we were looking at. I had a 5-cent earnings per share estimate. We came in at 6 cents per share, beating the Wall Street consensus estimate of a 3-cent per share loss. So it was very clear that this was not going to incorporate properly interest from this uninvested cash. You know, we got this Michael Pachter from Wedbush came out there and hit piece against GME. There's no reason why this should trade at its current prices. It should be $10 a share, and he issued this $10 per share price target. Right? Obviously, there are a lot of factors that are purposefully left out here. These analytics are they're perhaps reasonable from the perspectives that they come from, but they're not entirely reasonable insofar as there are many perspectives they do not take into account, especially insofar as, Roaring Kitty, Keith Gill, spoke about on his live stream back in June that this play was really a bet in this guy, Ryan Cohen. If you are invested in GME, if you are invested in GameStop, you are invested in the transformative potential of its CEO, Ryan Cohen, the sort of talent he can bring to GameStop and his own ability to transform GameStop the way that he transformed, really established Chewy by bringing in elements from this Amazon model, by building this into a profitable company. So the bet in GameStop, the fundamental bet in GameStop, is really a bet on Ryan Cohen versus the Wall Street finance machine's ability to drive a company into the ground with manipulative trading and investment tactics. So really happy to see that. Really happy to see that. Certainly on the long-term element for the GME fundamentals play, that's certainly very good. But despite the fact that this was great news, certainly for the company, for the fundamental aspect, does that mean in the short term we are going to see that bullishness, that bullish orientation toward those fundamentals reflected in our immediate price action? That's the question I had going in today, right? That's the question I usually have when going into my open interest analyses here, my options and technical analyses, trying to combine insight from these different angles. What really is happening on the day-to-day level at this price action, right? Because for how many years do we look at the fundamentals? Do we look at the sentiment? Do we look at the prospect of what's going on with GameStop? And we don't see that reflected in our day-to-day price action. So what really is going on there? That's what we're going to take a look at today, like we usually do. So let's hop into it. The first thing I'd like to do in reflecting on our price action, certainly, we're going to think about going into what happened in the after hours, right? So during the day, we saw the price trade down. We talked yesterday. I talked at this live stream amid these technical difficulties I was having with my recording platform, that we had this conflict yet again, just like we had through most of the first part of last week, a clash between this bearish regression channel and this bullish regression channel. So the bigger bullish channel, more stable, more in place, been unfolding for about 6 weeks. The bearish channel going on unfolding really not even 10 trading days. So it's really just since the Friday after Thanksgiving. May have started a little bit with some of our price action toward the end of Thanksgiving, but really it didn't come into shape until we got that heavy shorting day on 11/29 and then that heavy shorting day on December 2nd. So right, that traversed the whole of that bullish regression channel and then kind of started to eject us on Wednesday of that week. That would be the 4th of December, and did eject us that Thursday before Roaring Kitty dropped his post, and Wall Street algorithms, of course, pumped us right back up into that bullish regression channel. So yesterday, right during the day, we found ourselves in that same situation. But of course, after hours seems to have reversed a lot of that, moved us back into this bullish regression channel as a result of this particular element of the earnings report announcement. So something that Wall Street has often used as an excuse to dump the stock, right? They'll say, oh, revenue declined. Oh, right, it wasn't as profitable maybe as we want. Of course, right, this doesn't necessarily, like, it's good to know for the fundamentals, it's good to know for the long term, but the immediate effects, usually the price has dumped on the announcement of an at-the-market offering. Right here, Ryan Cohen and company announced that, in fact, GameStop will not be going forward, at least this is what's announced, does not expect to be going forward with any at-the-market offerings for the remainder of the fiscal year. I think this goes basically until February. So that's very interesting. There are some potential implications for this insofar as the kind of requel thesis might be concerned. Are we going through this uptick? Are we going through this beat for beat sort of rhyming of the key points of the 2020 to 2021 major GameStop upward volatility event that culminated in what is often referred to as the sneeze? Are we looking at something similar? Certainly, if we're not going to do any at-the-market offerings, that is an interesting component. This means we have something like a several-month stretch here where if you're short GameStop, right, if you came into earnings expecting this type of thing to happen, if you were hammering the stock thinking like, okay, well, I can internalize these trades, or I can kind of fudge the settlement here a little bit, something like that, there's going to be this at-the-market offering, even if it's a normal short trade, even if you're not fudging anything, even if you're not FTDing anything, right, that, okay, Ryan Cohen's going to come in, he's going to do another money raise, and then I can figure this out. I can close maybe some legacy synthetic shorts, or I can close my short position once, the stock kind of capitulates as a result of that. It certainly did look like there were some parties who were betting on that type of price action. So now, we're not going to get that. And it means, hey, over the next couple months, don't think you're going to have an at-the-market offering to bail you out of a short position if you enter into one thinking that something like that's going to come up. So Ryan Cohen here, maybe with the bear trap, maybe trap some institutions who now might have to head for the exit doors and give us a little kick up in the price over the next couple months. So maybe it's to prepare the way for something that the company is floating to announce in the next couple weeks or month or so. There's been rumors for a while now about somebody like Nat Turner joining the board. There's been rumors, even I think I saw this earlier today on Superstonk, somebody saying, hey, is GameStop going to acquire PSA? Is GameStop going to acquire the parent company of PSA, which Nat Turner is heavily involved in? Is Nat Turner basically going to head up the collectibles division within GameStop in a potential acquisition merger kind of event, right? Nat Turner, although he's been announced that he's been added to the board of GameStop for at least a year, in mid-November, the company announced this. Nat Turner has no compensation. He owns no shares in GameStop. What is this? What's this idea here? Like, what is with, they have this strategic partnership, but what's going on? Are they trying to strike up a deal here? Is Nat going to be, part of this acquisition is okay, GameStop's going to get the company, but then Nat is going to be, maybe compensated with shares, and he's going to have a compensation package of the sense, right? Not really a compensation package. He's going to be in the company like Ryan Cohen is, in terms of, he has no compensation, he has no salary, he just has what shares he has in the company, and that's how it is. So something like that, right, might be around the corner, something to keep in mind. But with that being said, let's dive into some of our analytics today with our typical data. So if you are joining us on YouTube, you can find a link to today's write-up, to today's article down in the description. If you're watching this on X, You can find this up above, right? I always keep whatever actual article I'm looking at for the day pinned to the page, so you can find that up top there. Yeah, so let's dive in here. So great EPS, no at the market offering, but watch potentially for some hype trap. Okay, this is what I'm looking forward to, or I shouldn't say not looking forward to. I'm not looking forward to a hype trap. I'm looking out. I should say I'm watching out for something like that, right? Company news is great. Bullish news, definitely. But in the short term, does that mean we just all of a sudden pump? Does that mean we just all of a sudden pump? You know, from the data overall, I'll say this up front, it's not looking like that is about to happen. Our overall bullish trend still intact, but it's not looking like, you know, oh, this week we just go nuts, right? Like the options market is primed to just pop. Hey, this can always happen. It can happen. I'm not saying this is a certainty, but certainly from our data, from the trading we saw in the after hours period and into pre-market right now, I'm not seeing this kind of immediate reversal and sort of abandonment of this bearish channel. So I'm going to walk through a bit today what I'm looking at and you know why I'm of this opinion. So right, yesterday with our price movement recap, we were looking, you know, we had this bull bear battle in this kind of zone, this overlap zone again between the bearish channel and the bullish channel. We had a couple moments pre-market. We had a couple moments very early in our trading day where we just sort of inserted ourselves back into the bullish regression channel. Again, that's the channel that is bounded on its lower end by the 104-hour moving average, synonymous with the 20-day moving average. But really, for the rest of the day, for most of the day, we traded right atop the midline of the bearish regression channel. We traded between that, which lined up almost perfectly with VWAP. I've talked about VWAP a little bit. I think I talked about it in my stream yesterday. Some of that I think was a little bit hard to see because I had some video issues. So I am going to do a video this weekend on volume weighted average price, why VWAP, why the volume weighted average price is an important intraday technical indicator, and what it means for trying to understand price action during the day, you know, how day traders use this in particular. But suffice to say for now, the midline of our bearish regression channel overlapped pretty much right for, I don't know, almost 4, maybe almost 5 hours today with our intraday VWAP support line, so 2 standard deviations below our volume weighted average price. And then later in the day, when we really started to move away from our bullish regression channel support line, we got some bearish options, premium imbalance, some bearish flow came in. We started getting pushed down, and we moved down below $27. Now, interestingly, at this moment, we did get picked up a bit. There was some tight inflows after maybe about 3 o'clock of some bullish options volume. Our IV did get to a pretty low level, and it was interesting to see us move below $27. We still ended the day here on a bearish premium imbalance, so a mildly bearish day overall. But yeah, we got quite a few sizable bullish options orders come in. So, you know, traders spending what, 25K right before the close on an options bet, right, on a $25 call, $28 call, $28 call. These are for a little bit farther out. This one though, this $28 call for Friday, somebody dropped 23K on that. You know, decent size, depends what that means for the trader. Like, you know, if it's a quick bet like that, I mean, ideally, like, I'm not spending more than, like, if I'm like, oh, let's go for it, I'm not going to spend more than like 0.1% of my portfolio value on a bet like that. So, you know, if this is a big guy, if this is a big trader, like 23K probably doesn't matter that much. But yeah, I mean, if this doesn't play out for this dude, like, he's going to get whacked today on the IV crush. So we'll see. Some farther out bets. Yeah, I mean, I kind of like this April $28 call. It's a little expensive for my bet, for my taste. I mean, if it works out, it works out. I do like the 20s. Like, I like to go in the money on stuff like that. I like to give myself plenty of time. If I think, all right, we're going to move up, this much. I like to make my money on leveraging intrinsic value gain. I don't like to buy options with a ton of extrinsic value in them, because that's the stuff that gets shellacked if things don't move the way you want them to move when you want them to move, right? So that's where you've got this implied volatility and time elevated delta, like a lot of the delta value in a contract that's mostly extrinsic value, like the 25s for April. Don't love the 25s right now, because their pricing is very heavily dependent on extrinsic value, whereas the 20s, a lot of what's in there is intrinsic value. So a bit, a lot more of that corresponds to the stock price of the underlying. So I'm a little bit, that's a little bit more my taste. So I like looking at, right, we did get these lower IV values, interestingly, before earnings, right? We see how we got this little bloop, this little bump up when all of a sudden a few traders came in. A lot of these traders up here came in and just started buying up options after 3 o'clock, buying up calls on some bullish bets. But yeah, we did have a pretty down IV day in general, that popped up again right before the close. So I think we got down to about 112% per Thinkorswim, Charles Schwab, the way they calculate IV, and we bumped up into the close probably around 120%. I think we were. So then, okay, but Michael, what about all this after hours action? Isn't this super bullish? Like, isn't this crazy? We went to $31. Like, isn't it clear we're going back? Maybe, but I would say that what I saw take place in this after hours price action was not anything that fell outside of the bound of measured moves. You'll notice when the company earnings came out and we dumped, we traded up. When it came out, we traded up to exactly to the midline of our bearish regression channel. We dumped down first. Our first touch was right on the line, and then we got shoved down just a little bit more below the support line of the bearish regression channel. And then we traded back up above the midline, traded down right to some of these where our intraday moving averages were hanging out. Right, we hung out there for a while, and then after hours, they decided to take us up. Whoever they is, whatever institutions decided to drop some cash on this, right? We had several million shares of volume pour in a few minutes here. Pumped us all the way up. Oh, and where did we go? Where did we stop? Where was the reversal? $31 on the nose, which, oh, by the way, happens to be the midline of our bullish regression channel. These are measured moves. This is exciting. It's cool. Like, you get excited. Oh, how high is it going to go? If I know, right? Like the first, 6 months, or even like close to, maybe not 6 months, maybe like 6 or 8 months that I was trading, I just look at a blank chart that's just candles. Like, I never had anything overlaid on my trading screen. And when you don't have any of these overlays, you're like, okay, well, this seems arbitrary, random, exciting. How high could it go? But measured moves, right? Statistical likelihoods. Whoever is moving this around reversed it at these key moments. So this is still paradigmatically contained. I'm not seeing anything that's paradigm breaking. I'm not seeing anything here. I didn't see anything that said, oh my gosh, like we're going to really crazy transform sometime soon, especially because we traded back down off of this, back out of the bullish regression channel, and then used the midline of our bearish regression channel once again that we traded on for a serious part of the previous trading day, of yesterday's trading day, as a support in after hours trading, and used the support line, the 104-hour moving average of the bullish regression channel, as a resistance. That ended up being, kind of this later day trading type of action that uses. And oh, by the way, at the time of writing this, starting maybe about 2 hours ago, 3 hours ago, we did the same thing. We didn't change our trading paradigm for the pre-market period. So we're still in this, right? We're actually still right now more bound to the bearish regression channel than we are to the bullish. We're still outside of the bullish regression channel, using the lower bound of the bullish regression channel as a resistance. So to me, this type of trading right now is still saying, hey, that bearish control that was there, that bearish paradigm that was asserting itself yesterday, that tried to assert itself before Roaring Kitty dropped his post back last Thursday, that's still in play right now. That's still predominating in our technical landscape. Bears have control over what's going on right now. I mean, that's not to say that down the road, right, that over the course of several weeks or even months, that our bullish trend is in jeopardy. That's not what I'm saying at all. But in our short-term price action, this still stands out to me as like, oh, be careful here, right? Be careful, because this $31 might encourage some hype in the short term. Maybe we get a quick little thing off the open today that pops us up quick, and then we go right back under into our bearish regression channel and kind of bleed down for the week, right? So I'm not seeing that, certainly in the technicals, reassert itself. And here if we zoom out on our 4-hour chart, you can see our use of these key levels even more clearly, right? I have them circled here. In our 4-hour chart, we didn't quite make it down here to the 200 4-hour moving average, but these are measured moves. And let's see, can I zoom in here? Yeah, I can zoom in. So you can see, right? Look at this candle. This candle, now, by the way, almost identical to the one that we saw, this 4-hour candle back with respect to the algorithmic reaction to Roaring Kitty's post on X. So the candle opened, the price opened this 4-hour period right on top of the midline of our bearish regression channel. Then it dipped down just below the support line here of our bearish regression channel. And then it traded all the way up to the midline of our bullish regression channel, and then back, closing the 4 hours right here at the resistance line of the bearish regression channel, the top line. So it fits this almost perfectly, okay? You couldn't have drawn this better. You couldn't have drawn this better ideally. So this was absolutely a measured move. I know to a lot of people, right? A lot of people maybe who are trading GameStop or investing in GameStop for the first time, something like this, investing in the stock market, right? This is a clearly measured move. This is what I see. Now, basically, what this tells me is that, yeah, this sort of, hey, I think we're going to move down maybe a little bit more. Hey, I think we're in for a consolidation in December. We still basically see that in the technicals. Now, this could change, right? People could come in, some heavily bullish bets. They could try to reverse this earlier. Something like, the sort of event like what Roaring Kitty, just some bit of information that stimulates hype or triggers these algorithms or something. Something like that can happen. That moves us back, right? That maybe tries to delay this trend or flatten out this trend or something like that. I don't think the price is just going to collapse, but I'm still not taking the kind of move down to 26, maybe try something in the 25s again. I'm still not taking that off the table, at least for me, right? So let's take a look at the options data and see what that says, right? So it's important to keep in mind OI changes. Anything that has to do with the options landscape is, when I check it in the pre-market, when I get my data drop at 6:30 Eastern time, it's around 6:30 Eastern time every day. It reflects the status of the options market at end of day the previous day. So after our stuff doesn't tend to factor into this, although our price point right now and what happened also doesn't really seem like it would stimulate some kind of crazy architectural restructuring in the options market. It could. This will take some time. It'll take a number of live trading days for something like that to happen. But what was really interesting, I would say, is digging into this. We got our usual concentration of new calls up here, of mixed sentiment. We got a lot of new puts, okay? Put volume yesterday was uncommonly high. Still predominating in calls, but we had over a third of our total volume in puts. GameStop rarely, at least for, I would say, the past 8 months, basically going back to like April, we're looking at 80-ish%, right? So only like 1/5 of our total volume on any given day is puts, I would say, on average, maybe a quarter at most. If we're thinking back maybe into like August, September, it's probably around a quarter. Yeah, in our bull trend, basically for November, it was like a 10th, right? Nobody was trading puts. If you go back and look at my articles, Superstonk people, right, you who were with me, you remember like just nobody was trading puts. Every time I would bring up the OI, it's like, oh, somebody bought 50 new puts today. Like, we were hardly getting any put volume, hardly any new put OI. Not like this, right? Not seeing, say, 5 consecutive whole dollar strikes with over 1,000 new contracts. So again, right, most of these too are skewed to the ask, meaning these are pretty convicted bearish bets, as I outlined yesterday, which means whatever's going on here, maybe it's because our IV was so low yesterday. Like that's a decently low IV value for GameStop heading into earnings. I think in Q2 earnings, our IV was like up in the 140s, 130. No, that's too high. It was, no, maybe it was. I think it was around like 145% because we really bulled up into earnings after running a couple consecutive Friday gamma ramps. We had these little gamma squeezes. So it was big going into the Q2 earnings report. It was high, and we dropped from like 145 down to 120 in like 5 minutes off the open on the day following. So that would have been September 11th. Yeah, so we definitely see these more convicted bearish bets, probably a little bit more appetizing given how low IV was heading into the close, or sort of later in the day that it was lower than 120. That's not crazy high. That is high versus like, well, we had year-to-date lows in October, which was like absolute golden opportunity to enter long calls if you did that. But yeah, interesting to see that. The effect on our max pain with respect to this is that it did actually move up. So market makers not as heavily incentivized to, say, push our price below 2750, right? So max pain is, I mentioned this, some of you who are familiar with max pain theory, this is the ideal optimal profit point for market makers on a given stock based on the total amount of open interest. So this strike represents a close, a weekly close, an options expiry close near this price point represents the price point at which the absolute maximum value of all current open interest expires worthless. So 2750. So market makers right now, in an ideal circumstance, again, I don't have access to their portfolios. I don't know actually what the balance of their bets is. It's 2750. So below 2750, technically this makes them relative bulls. So if the price is in the 26s or the 25s, max pain ideally suggests that they would profit more by allowing the price to go higher, since they'll have to their profits from puts, more puts are out in that area that would decrease their profitability relative to the calls that would expire by going deeper. So they become relative, right? Anywhere you see this, anywhere you see sort of a price versus max pain, and we finish below that, we're decently below that. That means that below that price point, market makers are hypothetically they're relative bulls. So we could still see, this doesn't say price collapse, but based on what we're seeing, say later in December, we're still seeing these $25 max pains. We're seeing this short-term put accumulation. I'm not pulling out the stops and going like, okay, now we moon, something like that. I'm trying to look conservatively, trying to be as realistic as I can based on what the data is telling me. Is more likely, right? Again, things can happen, but more likely, it's looking like we trade down a little bit, we consolidate a little bit, we let that IV thing get into place. Anybody who's holding, say, a ton of short calls can kind of reposition, can cash those out, can take profits for a bit while the price is down. And then once people have their portfolios, say, these institutional players with the ability to kind of manipulate price with their intraday actions, then they can maybe let the price go up, right? That's what we're seeing in our gamma exposure too, trending down, trending more in favor of put exposure. We see something like this, right? We still have these channels. We can see that lower down around 25, we are definitely negatizing, meaning this is being more controlled by put gamma. There's downside volatility potential being built into the price below $27. Basically 26.50, 26.50 is what spot gamma refers to this as like a gamma flip line. Or a volatility trigger. So we do have some downside volatility based on our price right now. We could trade up in this 27, 2050, maybe come knocking at the door at like 28, and then some shorting can push us down, and then we kind of just run at a decent pace downward until we get into this 26, 25, 50 area, right? This is a path of least resistance. Requires the least amount of capital commitment to get the most amount of dollar value movement with respect to our price. So options traders, institutions who have options positions, they're trying to bet on movements in the price. They're trying to influence movements in the price by affecting market maker gamma hedging patterns with their options bets. Path of least resistance right now is to the downside. It's not to the upside. Again, that starts to run out around 25. We do have a large total gamma position at 25, so there is some support there. Again, it doesn't, even though we have this accumulation of some decent put gamma and net put gamma below 25 at 24. I mean, if we go down to 25 relatively quickly, who's ever got these long puts at 24 can cash those out. Some of these might be short put bets. I think a fair number of them are long puts, if I remember correctly. At least 4,000 of the puts at this strike were open like end of last week here. So yeah, I think over the next, I could see kind of a quick movement down into the 26, 25, 50 area over the next couple days. What's interesting though is we do have call gamma inserting here at 27.50, 28.50, 29.50, kind of smoothing our transition here, right? We sort of ramp up into this $30 call position again. We know that this range has been pretty sensitive with the amount of call gamma that's concentrated up here, in part because of how much call gamma we actually still have out and focused at 31, 32, 33, something like that. So I could see a scenario where market makers, right, they get a little hype, they push us up a little bit. Maybe I say market makers, institutions hype us up a little bit, 27.50, 28, then kind of move us down. Hype dissipates a little bit, say tomorrow, right? Wednesday, today's Wednesday, today and tomorrow. And then toward the end of the day, right, when it looks like, oh, we're being pinned down here, we're going to maybe leg down lower, 25, maybe below 25, if we move down there. We might get one of these institutions comes in with some capital, drops a bunch of money on the options market. After we get this IV crush, we get delta crush from the result of this IV depreciation, and then whoop, just runs us right back up here really quick as market maker hedging creates something like a virtuous feedback loop where lots of call buying causes market makers to hedge, causes the price to go up, causes more hedging, causes excitement in the options market, causes more call buying, causes more hedging, causes more, right? This gamma squeeze dynamic, this gamma ramp dynamic, basically up into this 30, 50 area. And then, we trade, maybe up to like 29.50, who knows? And then we trade kind of down and close somewhere back down closer on Friday after that excitement, around 28 or 27.50, depending on how high we get. If we get a bunch of puts inserted in this area today, we might even see today and tomorrow, we might even see max pay move up to like 28. So who knows, something like that. That's a scenario that's on the table. Those of you who have been, reading along, following along for the better part of a couple months now, back on Superstonk, you'll remember we had some good times trying to predict when these gamma ramps might go off. So August 27th was a big one, September 6th. Not the next one, not September 13th, but September 20th, if I'm not mistaken, was another big gamma ramp. And these tend to happen on Fridays. Why do these tend to happen on Fridays? We have an effect from the options Greek charm set in, which charm is the change in delta relative to the amount of time value in the contract, so theta. So you have theta as a value within the contract, right? Part of the extrinsic value of the contract is how much time is left before expiry. That's expressed in terms of theta. The delta value, right? How the leverage between the contracts, between the contract and the underlying is assessed, is partially determined by how much theta value on its own is in the contract. So that delta value declines over time as theta declines, or it increases in terms of, okay, so for in the money contracts, it increases over time as you get closer to expiry. As theta goes down, delta goes up for in the money contracts because you lose the potential for it to go down. It becomes less likely that it will close out of the money, and so the delta actually ticks up. But for out of the money contracts, as you get closer to expiry and you stay out of the money, delta value goes down in terms of time. So as time passes, it becomes less likely that it will go in the money, so the delta value goes down. So what happens on Friday is you end up with usually a ton of contracts with low delta values, especially if they're out of the money, that are not that far away, right? You might see, what was it, like last Friday, we saw something like our price was around 28.50, 29. And while that was the case, right, the delta on the 30s was something like 13, right? So for every dollar of change in the underlying, the delta, the contracts would only appreciate by 13 cents. Okay, but if you can vacuum up a lot of those contracts super cheaply and then do something to, really quickly move the price up, say from $29 to $30, the delta on that's going to change really fast. Okay, so what happens is market's open, get ready. What happens is that charm sets in, decreases the valuation on these deltas, but then institutions can come in on a Friday and really ramp those up, right? So the sensitivity, the contracts are going to be very sensitive to changes in delta, meaning they're going to have high gamma values, these out of the money contracts that are closer to the money. And so you can really easily stimulate a gamma run, a gamma ramp, or a gamma squeeze, sometimes it's called. So yeah, we might see something like that this Friday. Need to see how things play out over the next couple of days. And yeah, we'll see actually, right? The market is open now. So we can take a look if IV is just going to chunk its way on down. Doesn't look like it is yet, although our price is doing some fun jumpy jump things. But we'll have to see. We'll have to see. That's where I think I'm going to wrap up the video for today. Yeah, thanks so much, you guys, for tuning in. Go take a look at the article. Good luck out there with your trades, and let's go GME. Thanks very much, you guys. We'll see you next time.